Welcome, ladies and gentlemen. It's great to be back with you all after taking a month off from our regular 6-minute strategy talks. We've actually published over 90 since the early days of the COVID pandemic. Thank you also to all of those who attended day one of our charity conference in London this week, and apologies if I cover some of the same ground again today. Over the last few months, the odds of a soft landing, that is when inflation falls back to target without triggering a recession, have continued to rise. Yes, the final approach to central bank targets of around 2% may yet test policymakers. This week's US inflation print was a little hotter than expected, but the odds of success are good. It's worth remembering that soft landings are rare. There have probably been only 2 genuine examples in the last 60 years. First under Alan Greenspan as Federal Reserve Chairman in 1994, this certainly contributed to his almost godlike status at the time, and before that in 1965 under the longest-serving Federal Reserve Chairman, William McChesney Martin. What is particularly impressive today is that a probable soft landing is not just a US phenomenon. In fact, in almost every developed country in G20, we're close to reaching the inflation targets without triggering recession. The IMF also identifies 5 major emerging economies which could do the same. This is a very impressive tally. We'll look at this in a little bit more detail in the slides ahead and what it means for interest rate cuts and portfolio strategy for you in the remainder of 2024. So forgive me for beginning with a slightly more complex chart. This was shown by the IMF to G20 earlier in the year, and if politicians can manage to understand it, then I'm sure we can too. On the x-axis, GDP growth forecast for 2024. On the y-axis, how far any country is from its own inflation target. Anybody in that green box, soft landing runway or close to it, has effectively achieved a soft landing. And the first thing you notice is how many countries are there or thereabouts. The developing countries in blue, Great Britain, Spain, Japan, Italy, etc. And interestingly, a strong smattering of emerging market economies, Brazil, Mexico, Indonesia and India achieving extraordinary growth on the right there and still in target. China achieving the growth target but not the inflation target, and Argentina, Russia and Turkey outside of the box by any normal measures. This is a global phenomenon and that's extraordinary. What does this mean for inflation going forwards? Well, it means that sharp fall off we've seen in the last 9 months, remember the UK inflation was up above 11%, can steadily continue. It won't be a straight climb, we'll have some challenges as we saw in the US CPI print, which is a little hotter this month, but the direction of travel is clear. What does it mean for the UK? Well, I've split out the components of inflation there on the right. You can see those blue bars going negative. That's housing and utilities, that's energy prices falling. That'll be particularly powerful in Q2 because the new Ofgem price cap comes in, which is a 14% reduction in household bills. And that could possibly take inflation, those diamond bars, down below 2% over the next few months. We'll probably end the year in the UK here at 2.5%, coming back to target officially in 2025. So why have prices fallen so fast around the world? Well, first of all, COVID supply chains, which were so disrupted by the pandemic, have healed remarkably quickly. You can see in that left-hand panel supplier delivery times. That's the time after an order to get to the factory gate. Those supplier delivery times coming right back down to somewhere near normal. Similarly, the global supply chain pressure index on the bottom left panel, again normalising where we were pre-COVID. And tanker rates on the right-hand side doing much the same thing. Now you will notice a spike in those tanker rates, particularly the World Container Index there in red. That's the impact of the Houthi dispute and the problems in the Suez Canal. The IMF just reported that Suez trade has fallen by 50% from a year earlier because of attacks on vessels. And it's also worth noting that in the Panama Canal, we've seen a 32% fall in traffic because of drought. So yes, the numbers are good, but there are still pressures, but that won't, I don't think, alter the strong deflationary backdrop. The second factor which I think is important is energy. And we owe a lot here to the US. You can see in that left-hand panel the extraordinary growth in blue of US energy production, from around about 7.5 million barrels per day 10 or 12 years ago to nearly 20 today, leaving the US effectively self-sufficient in oil and the biggest producer. Similar events have happened in gas. In fact, gas is now, LNG is also the biggest exporter, and that's been incredibly important for Europe. What it means, of course, is despite the Ukraine war and the terrible conflict in Gaza, that actually gas prices and oil prices have fallen sharply. In gas's case, the price is actually somewhere near a 30-year low in the US. So we've been hugely helped by this US and North American energy production. Third and finally, of course, we've seen very powerful and worrying deflation forces take hold in China, really coming out from the property crisis and possible banking crisis this may cause. Inflation is just about positive. Export prices, though, are falling very sharply. And this means Chinese goods are very, very cheap. And this too is holding down inflation. You can see it most dramatically in the right-hand chart as Chinese product begins to hit markets in new industries. If you look at, for example, exports of cars, only a few years ago, the leaders were Germany, Japan, South Korea and US. Now look at that rocket of Chinese exports, motor exports, particularly of EVs, with the MG4, a Chinese model, now the second most popular car in the EV market in the UK. So let's consider what this means for interest rates. We expect that central banks will be confident enough of these numbers to start cutting round about June. The Americans will want to go onto a pre-programmed trajectory so they're not accused of electoral bias in November when the presidential election comes up. So I expect a quarter point at every Fed meeting this fall for the second half of the year, taking us from 5.5% down to 4.5%. Probably another couple of cuts in 2025. Then I think a pause to reassess. Here in the UK, I think we'll start about the same in June, probably slightly less frequent cuts, 3 probably in 2024, which will take rates down from 5.25% to 4.5%. Again, a couple more in 2025, and then a pause somewhere around 3.5%, which we regard as the neutral figure here in the UK and probably the US as well. Well, I hope that's helpful. I hope it explains why inflation has fallen so fast and why a soft landing looks like the likely outcome for much of the global economy. This is positive for financial markets, positive for equity earnings, and is behind our overweighted equities of the last few months. Thank you.